Welcome back, welcome back, welcome back. Welcome back, welcome back, welcome back. Come on in. What's going on, everybody? So I'm considering doing this, just doing this Cypher School class live today. This spring break, and it's technically not part of the course. I do think it's kind of important that everybody sees this, so I think we might just do it here. We're doing it live. Yeah, XLM and H bar look decent. Yeah, in about 30 minutes. Just getting a couple of the things together, and then we'll intro it. Sounds good, Crazy Train. I suggest you skim through it just in case. All right, everybody get your drinks and your snacks and stuff. Let me send a message to Discord to let them know that we're doing it in on it live. All right, y'all. We got about 10 minutes. All right, got my coffee. What's good, Joe? Bitcoin's probably gonna behave and just go sideways, give us some time to cook. So don't be too worried about that just yet. If you want to overall sort of look, you want to look at XHB, Home Builders, Home Builders ETF. Usually a pretty decent canary in the coal mine. I mean, it depends, I guess. The bond markets right now, just for TLDR, aren't doing anything that they're not supposed to be doing. We'll go into it and we'll explain why. um, the shock or whatever, or the big deal everybody's making out of it is because it doesn't jive well with their idea of a super cycle. Right? But if you're looking at it how we've been looking at it, that we're getting to the top of the everything bubble, and we know that we're at our 18.6 year real estate cycle turn, then this isn't a shock, right? It's just evidence that we're on the right track. But yes, if you were expecting some half decade long super cycle recovery, that's not a it's not a good sign. If you're expecting rate cuts, also not a good sign. It's been over a month now when I came in here and I said, you know, unpopular take, but don't be surprised if they raise rates before they drop them. And it sounded like complete lunacy when I said it, even to me when I said it out loud. This is when we went and we talked about Volkner. We talked about Powell and his legacy and all that. It was around that deep dive. Because remember, Volcker raised, right? But we were arguing that you couldn't raise in the condition that we were in with oil as high as it was. But things are getting bad, right? Inflation's ramping up. And you're starting to hear some of these governors talk about raising rates out loud, like not in the quiet, backroom negotiations, but to the press. Remember what I said about the Fed. The Fed does not like to surprise. The Fed doesn't like to come in and surprise because that shocks the market and makes their job harder. So the Fed tends to leak information so that when it finally gets announced, it's not a huge surprise to everybody. The market's already digested the possibility of it. If you start hearing Nick the Snitch talk about it on Twitter, we lovingly call Nick the Snitch, what other people call the Fed Whisperer. It's really just their snitch. Whenever they want news to get out, they go to Nick. Nick Timmerose. You should definitely be following him on Twitter. He hasn't said anything yet, but I'm saying I'm waiting for it. You're already seeing some of these governors say that they're not opposed to the idea of a raise, out loud to the press. But I'm saying when you hear Nick start to talk about it, that's probably when we should start. Yeah. Yeah. Be honest with you, it's the only responsible thing to do. How do you cut rates in this environment? And obviously keeping rates the same aren't stopping you have a responsibility to stop inflation. So at some point that hard decision has to be made. Conveniently, they wait till it's time for them to take profits on legacy, but whatever, we won't go there. We'll stick to the facts. Convenient though, right? Timuros. Yeah, it's like a Timo. There might be a U in there, RIS. If you just put Nick Tim, it'll probably pop out. All right, so trying to figure out what's the best way to do this. Has anybody seen bonds lately? First of all, quite the opposite. A lot of selling going on. Tons of selling going on. We'll take a quick look and we'll get into some of the content and then we'll come back and look at the charts and then we'll listen to the clankers. So give me 1 second, actually. Hold on before we start. All right. First, let's take a look at those charts. So US 30-year. About to break 5%. Which means this is what the US government is willing to pay you to hold their debt for 30 years. And you're like, okay, well, what's the big deal? Well, the big deal is that that's a lot of money, right? For a country that's very much in debt. It's unsustainable. Now, the way that we're defending against this is that the Fed, remember we looked at, so we could look at it right now. You look at WACL, or if you look at the assets, basically. Right. So this is, which we know from, unfortunately, from this bull market, this is our QE/QT, right? These are the Fed assets. Either they're selling off assets or they're adding assets to the balance sheet. Well, from this point here, right, you can see that we started to tick up. We've actually got a little W. Right? But why? Like, where's it going? So they're not calling it QE. What they're calling it is yield curve management. What that means is they're buying the US bonds or they're buying the US debt that these countries are selling off to try to control the yield, to try to knock the yield back down. Right? If you ever want to know what bond sales look like, you invert yield. That's what's happening to US bonds right now. Right? To incentivize buying those bonds, since everybody's dumping them, the yield has to continue to rise. Now, the problem is, even though we're the, biggest country in the world, blah, 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 pound our chest, we don't have the money to pay this. Now, if we don't have the money to pay this, then what do you think Great Britain, Australia, France, Japan, Germany, Italy, what do you think they're going to do? They're dumping off US debt as heavy as they can so that they can use the money to do exactly what we're doing, right? Which is help control their yields. Look at China. One of these things look different. So if Chinese yields look like this, pay no attention. Like, just ignore the fact that their chart skips from 2002 to 2009. It's just apparently magic. But if Chinese yields look like this, right, that means Chinese bond sales look like that. So why the hell is the world buying up Chinese bonds if you only get 2%? Well, that goes back to our petrodollar argument. The world bought US bonds because they needed dollars to buy oil. Like, well, why didn't they just hold a bunch of money in their bank? Well, for the same reason that we don't. Right? Debasement. So instead of holding US dollars, they hold US debt and they hold US equities. They invest in America, and then the money that they get from that, they use to buy oil. Well, the world doesn't see the need for that right now, right? As we can tell by these yields. What they do see the need for is to have exposure to the Chinese yuan, right? But instead of buying oil, instead of buying just the yuan and holding it for the same reason they don't hold the dollar, they'll buy Chinese debt. Right? I don't expect them to buy. You can tell by the Chinese market that they're not loading into the market. But when it comes to transacting with China, one of the best ideas, in my opinion, is to load up on gold, and then you just sell it on the Shanghai market whenever you need to buy that oil, whenever you need to transact. Right? We just opened China up to more than half of the world with this trade deal that we did. That 500-year wheel that we talk about, that empire wheel, this is what it looks like when it starts to click. You know how we talk about rotations in crypto or equities? You know how we're watching Bitcoin, gold, equities to see where the money rotates? Well, this is that same thing on a global scale, on the 500-year scale, right? Where's the money going? Why does the world trust holding 30 years of Chinese debt over 30 years of anybody else's? Right? This is in my opinion, this is a direct effect of what we're doing in Iran. So we got that inflation surge, obviously, because of what's happening in Iran with oil. Right? We've got major foreign lenders exiting, trying to cut US debt holdings by 50%. That, in my opinion, is an attack. Remember, we talk about this Cold War between us and China. That's an economic attack, right? Dump 50% of our debt. Interest on our debt's over $1 trillion annually. So what does the Fed do? Can't lower rates, right? Because we'll go into hyperinflation. Really don't want to raise rates because you'll crack the economy's back. But in my opinion, this is the best choice that we have right now. If we stay flat, inflation is just going to keep going. We're already in a bear market. Equities are coming down. People already expect assets to come down. Real estate's coming down. Raise the rates. Raise the rates. Not a popular opinion, obviously, but so I put a report together. I put some visuals together. We're going to go through those now. And then we'll listen to the clankers, and then we'll come back to the charts. Everybody good? Audio good? Put one in the chat if you can hear the duck. All right, back. Let's see what Bobby got for us. All right, so we're not getting audio on that. Give me a second. So how do we have audio on this, but we don't? Give me 1 second. All right. Do we got a duck on Discord and on YouTube?
I hear the duck.
All right.
Does not happen often. In fact, most people watching this have never seen it happen in their lifetime. Every major bond market on Earth, the United States, Japan, Germany, the United Kingdom, is breaking at the same time. Not one of them, all of them, simultaneously. Bobby is about to walk through what that means, why it's happening, and what it means for your portfolio. Two stories broke the same week. The U.S. 30-year Treasury just hit 5.19%, a 19-year high, and Japan's 30-year government bond just touched 4% for the very first time in history. Two different countries, two different economies, same signal. Class, when two stories like this land in the same week, you pay attention. Here is the lesson Cypher School has been teaching for a long time. When a government borrows more money than it can ever realistically pay back, that debt does not disappear. It accumulates. It compounds. It gets refinanced at higher and higher interest rates, until one day the bond market, the people lending that government money, finally say, "We want more. We want a higher rate to compensate for the risk." That day is today. Japan is the perfect example. Japan's 30-year government bond just hit 4% for the first time ever. Here is what that number actually means for the Japanese government. At that rate, interest payments alone would consume 50% of every single yen of tax revenue the country collects. Half of every dollar the government takes in, just to pay the interest bill. Nothing left for schools, nothing left for roads, nothing left for defense, just interest. This is not news to people who have been paying attention. The warnings have been there for years, decades. Economists, traders, anyone who looked at the math could see this was the trajectory. The markets looked away. Politicians looked away. The media looked away. But math doesn't care who looks away. The bill eventually comes due, and right now, every bond market on Earth is presenting the bill at the same time. Let's go back to basics. This is important. A bond is a loan you give the government. They promise to pay you interest over time and return your principal at the end. Now, here is the key question. If the government needs to borrow $1 trillion, but the pool of willing buyers is limited, what has to happen to attract those buyers? The rate has to go up. Higher yield, more interest, a better deal for the buyer. Now imagine that's not 1 trillion, it's 5 trillion, 10 trillion. And the pool of buyers is the same size, the rate has to go even higher to attract enough demand. This is not complicated. This is supply and demand applied to debt. But there is a second reason yields rise, one that is harder to see. It's called the confidence premium, or sometimes the term premium. When investors start to doubt whether a government will actually manage its debt, whether it will default, inflate it away, or just keep borrowing forever, they demand extra compensation just for taking the risk. It is a trust tax. You want me to lend you money? Show me you can handle debt responsibly, or pay me more for the risk that you can't. Right now, global bond investors are charging governments a higher trust tax, and that message is loud. Here is where this gets dangerous. Pay attention to this part. When debt is high and rates are rising, there is a potential spiral. Higher rates mean higher interest payments. Higher interest payments mean the government needs to borrow even more money just to cover those payments. More borrowing floods the bond market with new supply. More supply pushes rates even higher, and the loop feeds itself. This is why bond markets don't just drift, they break. They go from manageable to crisis faster than anyone is ready for. Every one of these governments is staring into this same loop right now. For more than a decade, markets lived in a kind of permanent sleep. Zero interest rates, quantitative easing, easy money everywhere. Governments could borrow for almost nothing. The bond market asked no hard questions. That era is over. The market has woken up. And a market that has been asleep for 10 years. When it wakes up, it doesn't do it gently. The U.S. Treasury bond market has been in a bull market, meaning yields declining, prices rising, for over 40 years. 40 years. That is longer than most people in this Discord have been alive. This downtrend was the bedrock assumption underneath almost every investment model, every pension fund, every 60-40 portfolio on the planet. Lower rates. Forever. That was the assumption. The U.S. 30-year Treasury just broke above 5.19%. That is a 19-year high. And more importantly, it broke the 40-year downtrend line. A trend line that holds for 40 years is not just a line on a chart. It is the embodiment of a belief system, the belief that fiscal policy would get under control, the belief that inflation would stay low, the belief that the U.S. government's credit was essentially risk-free. When that line breaks, those beliefs break with it. What comes next is price discovery. The bond market is trying to figure out what U.S. debt is actually worth in a world where none of those old assumptions hold. That process is not fast, and it is not comfortable. Here is what most people miss about rising Treasury yields. The 10-year Treasury is not just one investment product. It is the reference rate for the entire U.S. economy. Mortgage rates are priced off it. Corporate bonds are priced off it. Student loans, car loans, business credit lines. When Treasury yields go up, everything goes up. The cost of every dollar borrowed anywhere in America increases, and when the 30-year is at 5.19, that is not a small adjustment. That is a structural repricing of the entire cost of capital. We are already seeing it in housing. We are about to see it in corporate debt. The yield curve is one of the most important signals in all of finance. Normally, short-term bonds pay lower rates and long-term bonds pay higher rates. You want more return for locking your money up longer. That makes sense. This is called a normal yield curve. Short end low, long end high. A gentle upward slope. The shape of this curve tells you what investors believe about the future. A steep normal curve says, growth is coming, inflation is expected, the economy is in expansion mode. When the curve changes shape, something has changed in the belief system. What is happening now is called a bear steepener. The long end, 10-year, 20-year, 30-year bonds, is rising faster than the short end. In a normal recovery, a steepening curve is good news. Growth expectations are rising, but this steepening is not about growth. This is the long end rising because investors are demanding higher compensation for long-term risk. It is a fiscal steepener, a skepticism steepener. It says, we do not trust what happens to government debt over the next 30 years. Pay us more. Now. The yield curve has predicted every U.S. recession in the modern era when it inverts, when short rates exceed long rates. We had an inversion for a long time. Then it normalized. Now it is steepening sharply. The sequence, inversion, normalization, rapid steepening, is historically one of the most reliable recession warning patterns in the bond market. This is not a prediction. This is a signal that the market is repricing long-term risk dramatically. The question is not whether the signal is there. The signal is there. The question is whether you are positioned for what the signal is saying. Japan has the highest debt-to-GDP ratio of any developed nation on Earth. For decades, Japan made this work through a specific system. The Bank of Japan controlled their bond market, kept yields artificially low, and domestic investors, banks, pension funds, insurance companies, absorbed the debt quietly. It was a closed system, and it worked, until it didn't. Japan's 30-year bond yield just hit 4%, for the first time. In history, that number seems small, but for Japan, it is the sound of a dam cracking. Here is the math. At 4% on Japan's current debt load, servicing that debt would consume approximately 50% of all Japanese tax revenue. Every yen the Japanese government collects in taxes, half of it goes to interest, before a single road is paved, before a single soldier is paid, before a single yen of social services. Japan's government spending deficit would explode. They would have to borrow more to pay interest on the debt they already have. This is the exact spiral we described earlier, and Japan is staring directly into it. Japan has another variable that makes this more dangerous: the yen. If the Bank of Japan allows rates to rise to stabilize their bond market, the government's interest burden becomes existential. If they hold rates artificially low to protect the budget, the yen devalues, importing inflation into an economy that cannot easily handle it. There is no clean exit. There is only the question of which problem they choose to have first. The global market is watching, and right now it is not confident in the answer. This is not an American problem. Germany's 10-year Bund, the benchmark for European sovereign debt, just broke its multi-decade downtrend. The German Bund is to Europe what the U.S. Treasury is to America: the foundation, the reference rate, the assumed safe harbor. When that breaks its long-term trend, every European government that prices debt off the German curve gets repriced along with it, and every European government is carrying more debt than it was a decade ago. Europe has a second problem inside the first problem. The Eurozone is a chain. Every country uses the same currency but runs their own fiscal policy. When rates rise, the weakest links in that chain, the countries with the highest debt loads, the most fragile budgets, feel it first and hardest. Italy's debt is over 140% of GDP. France is approaching 115%. The spread between German and Italian yields is a risk barometer the whole world watches. When it widens, it is the bond market saying, "We do not believe Italy and Germany carry the same risk." Right now, that spread is widening. The European Central Bank faces the same impossible choice as every central bank right now: raise rates to fight inflation and defend the currency, and crush already fragile government budgets, cut rates to protect the weakest governments, and lose credibility in the inflation fight, weakening the euro. There is no lever in Brussels that solves all of this at once. The market knows this. That is why European bonds are selling off across the board. Right now, there is a lot of noise about why this is happening. Some point to tariffs, some point to the war in Ukraine and the energy crisis, some point to the dollar, some point to Fed policy. All of those factors are real. None of them are the root cause. The root cause is simple. Global governments have been spending more than they collect for decades, and the bond market, the people actually funding this, has finally decided to say something about it. The headline reasons change. The structural reason does not. The U.S. dollar is the world's reserve currency. It is the medium of global trade, the pricing mechanism for oil, the bedrock of the international financial system. When U.S. bond yields rise because of genuine fiscal concern, not because the Fed hiked rates, but because the market is demanding more compensation for U.S. debt risk, that is a qualitatively different signal. It raises a question the dollar has not had to answer for a very long time. Is U.S. debt still the world's risk-free benchmark, or is it starting to price in a risk premium? That question, once it enters the conversation, is very difficult to put back in the box. Gold. We talk about gold at Cypher School not because it is exciting, not because it goes up in a straight line, it doesn't, but because of what it is in structural terms. Gold has no counterparty risk. It does not depend on any government's promise. It does not yield anything, which is precisely why it does not need to. When bond yields are rising because the market doesn't trust government fiscal management, gold becomes more valuable, not less. Every percentage point of trust that leaks out of the sovereign debt system flows somewhere. A significant portion of it flows here. Gold hit all-time highs this year against every fiat currency on Earth, not just the dollar, the yen, the euro, the pound, against all of them simultaneously. That is the market telling you something with precision. The problem is not the dollar. The problem is paper currency in general, backed by governments who have made promises they cannot keep. Gold is not going up. Government debt is going down in real value. That is a very different statement, and it matters for how you position. In 1980, Federal Reserve Chairman Paul Volcker did something almost unimaginable by today's standards. He raised interest rates to 20%, not 5, not 7, 20. And it worked. Inflation broke. The dollar held. The economy eventually recovered. Every time someone asks, can't the Fed just do what Volcker did? The answer is technically yes. But there is one number that makes Volcker's path impossible today. The United States currently carries approximately $36 trillion in national debt. At Volcker-style rates, even at 10%, the annual interest bill on that debt would be $3.6 trillion. The entire U.S. federal budget is approximately $6.5 trillion, more than half of everything the government spends just to cover interest. Volcker could raise rates aggressively because the debt load in 1980 was manageable. Today's debt load means that aggressive rate hikes would trigger the fiscal crisis they are trying to prevent. The Fed is constrained, the Volcker door is there, but the debt chain won't let it open. This is the trap every major government on Earth is sitting in right now. If they allow inflation to run, real wages fall, living standards drop, political stability deteriorates. If they raise rates aggressively to kill inflation, interest costs explode, government budgets collapse, recession becomes severe. There is no clean option. There is only the question of which wall hits first and how you are positioned before it does. This is why understanding the bond market matters, not as an abstract macro exercise, but as a direct input to where you put your capital. This is the lesson. Bond markets are not boring. They are the foundation of everything. Every interest rate, every mortgage, every business loan, every stock valuation. When bond markets break, they do not stay broken in isolation. The damage spreads to every asset class, to every corner of the economy. The question is never whether you are exposed to this. You are exposed. Everyone is. The question is whether you understand it, and whether you are positioned for it. Cypher School exists for exactly this moment, when the headlines are noise and the charts look scary and everyone has an opinion. We come back to the fundamentals. Understand the macro, understand your position, understand your risk. That is the work, and that work, right now, matters more than it has in a long time. Class dismissed.
Class is not dismissed, by the way. I don't know what she's talking about. One thing that we didn't sort of look at when we took a look at all these bonds is what it means historically. Right? We hear these words thrown around: 20 years, 30 years, 18 years, whatever. When's the last time that our yields got this high across the board? (2008) housing crash was the last time that our yields popped up to this point. And it wasn't off of fear. Right? These things correct for a reason. you don't understand the cycles, then that means nothing to you. But look at it across the board. So if you don't think it's important, cool. But just be aware so that you can make that decision educated and not just emotional. Take a look at all of it. Doesn't mean anything to you, cool, right? But don't stick your head in the sand, because that's not going to help anybody.
Welcome to this intelligence report on the fiat denominator crisis. The global bond market, a $140 trillion backbone of all global liquidity, is fracturing. This is a systemic loss of confidence in sovereign debt management, a mathematical certainty, not a cyclical correction. We are witnessing a total institutional revolt. The U.S. 30-year Treasury crosses 5%, the highest since pre-crisis July 2007. This indicates a sovereign risk premium, with investors demanding maximum yield to counter an accelerating fiat denominator collapse. The Federal Reserve is in an algorithmic trap. Cutting rates leads to violent inflation spikes, while raising rates risks credit default surges, a housing market freeze, and an economic collapse. The architect has failed. No mathematical escape exists. The algorithmic trap is accelerated by three converging systemic catalysts: the hidden inflation shock, the foreign exodus, and the death spiral math. These are the three vectors of collapse. Vector 01. The hidden inflation shock shows a physical disconnect, with raw material prices surging. The supply chain enforces a 3 to 6 month lag, meaning the retail price shock is already locked in, overwhelming paper manipulation. Vector 02. The foreign exodus highlights countries like China and Japan dumping U.S. treasuries. Japan, forced to defend the collapsing yen, is accelerating U.S. yield spikes in a self-reinforcing doom loop. Vector 03. The death spiral. Math reveals a $39 trillion national debt and a $2.5 trillion annual deficit. With over $1 trillion spent yearly on interest and debt to GDP over 120%, the 1970s precedent suggests only one conclusion: they must print. The Warsh sleight of hand involves the deployment of new Fed Chair Kevin Warsh to manage the optics. The playbook is to shift the inflation metric to trimmed mean PCE to artificially strip out extreme physical price increases and hide raw inflation data. Do not trust the paper metrics. Track the physical reality. The Cypher execution requires an immediate pivot to non-sovereign stores of value, as the fiat denominator is compromised. Assess the landscape and compare stocks, gold, and Bitcoin against the terminal math. Stocks show a flashing terminal warning. Forward PE is at 24x, and price to sales are at record highs. The Buffett indicator, adjusted for federal debt, has crossed 100% 3 times: 2000, 2021, and the present. Gold is geopolitical insurance, with central banks hoarding vast amounts, actively diversifying away from treasury bonds. They seek a baseline asset that is entirely devoid of sovereign counterparty risk. Bitcoin is the final mandate due to its fixed supply imperative. In a world where governments must print money, absolute mathematical scarcity is the only escape velocity. Geopolitical actors are already demanding Bitcoin for oil settlements. The Cypher execution matrix provides the mandate: terminate stocks due to high systemic risk, hold gold with its low systemic risk, and execute Bitcoin due to zero counterparty risk and absolute mathematical scarcity. The Cypher directive is clear. The fiat denominator is mathematically compromised. Track the capital flows, ignore the media noise, and position yourself outside the sovereign blast radius. Execute.
Welcome to this declassified Dbloc briefing from the Cypher School. Today, we are analyzing the terminal state of global markets. Specifically, the $140 trillion global fiat bond market is actively breaking down. A systemic, structural fracture is currently moving through the global financial system. The immediate catalyst for this fracture is visible right here. This chart displays the U.S. 30-year Treasury yield. Notice what happens at the edge of the data. The yield has violently crossed the 5% threshold. To understand the severity of this move, look at the historical context on this chart. We are matching peaks not seen since right before the financial crisis, all the way back to July 2007. Yields returning to these 2007 levels indicates that the market is reevaluating its long-term trust in government solvency. A government bond functions as a psychological measurement of confidence. It is a promise to pay, an IOU, and its value depends entirely on the market's belief that the government can actually settle its debts. When investors perceive an increase in risk, they demand higher yields as compensation for holding that debt. This requirement for higher interest is what drives sovereign borrowing costs upward. This shift is occurring simultaneously in the UK, Germany, France, and Australia. Multi-decade high yields are appearing across all major economies at once. The foundational asset of the global financial system is being universally rejected. The fiat denominator itself is cracking. The Federal Reserve is currently locked in an algorithmic trap with no clear escape vectors. Path 1 is to cut rates. If the Fed eases liquidity to stimulate growth, they risk triggering a global bond market revolt.
Not going to happen.
Under this scenario, yields would likely spike regardless of their target, as inflation begins moving in a hyperbolic direction. Path 2 involves holding or raising rates. At these levels, the cost of capital will mathematically crush the domestic economy. We are already tracking the consequences. Credit card delinquencies have crossed 12%, auto loan defaults are climbing, and private credit markets are beginning to freeze. The central bank is forced to choose between breaking the bond market or breaking the economy. Because the Fed has lost control of the cost of capital, the long-standing assumption of a soft landing has become obsolete. Our report identifies 3 specific macro pressure points. The first is the hidden inflation shock. While paper market activity can mask price action, the physical reality is that oil has remained stubbornly above $100 a barrel for months. Oil serves as the base cost for the entire economy. Its price dictates the cost of shipping, fertilizer, manufacturing, and food. This chart highlights a significant discrepancy. The producer price index, representing raw material costs, has reached 6%, while the consumer price index lags behind at 3.8%. There is a built-in supply chain delay. Increases in commodity costs typically take 3 to 6 months to reach retail store shelves and consumer wallets. Institutional bond investors see this delayed inflation wave coming. They're selling bonds now to avoid the negative real yields that follow rising prices. Threat factor 2 centers on the catastrophic vanishing of America's primary global lenders, a structural shift currently draining massive amounts of liquidity from the system. China has maintained a long-term exit from the U.S. Treasury market, reducing its holdings from $1.3 trillion to $650 billion over the last 17 years. Japan, currently America's largest lender, is now mathematically forced to liquidate its U.S. Treasury holdings. Japan requires dollars to defend the value of the yen and to secure the hard currency needed for energy imports. This creates a mechanical doom loop. When Japan sells treasuries to save the yen, reduced demand pushes U.S. yields higher. Higher yields make the dollar stronger, forcing Japan to sell even more treasuries to maintain its currency's defense. Japan cannot simply raise its own interest rates to stop this cycle. Doing so would jeopardize its 260% debt-to-GDP ratio, risking a total breakdown of its own domestic bond market. As foreign buyers exit, the United States must offer higher yields to attract domestic capital, further tightening the sovereign squeeze. Threat Vector 3 identifies the accelerating debt trajectory of the U.S. Treasury. The baseline arithmetic is staggering.
The national debt stands at $39 trillion and is expanding by approximately $2.5 trillion every year. At current rates, the government is bleeding over $1 trillion annually just to cover interest payments. Since these numbers cannot be reconciled through standard reasoning, the institution's primary survival tactic has shifted towards statistical manipulation. Kevin Warsh, a central figure in Federal Reserve policy planning, has advocated for a shift in how the institution calculates its primary inflation data. The proposed change involves moving away from the standard core PCE to a metric called the trimmed mean PCE. This new metric selectively deletes extreme price increases, allowing the government to present a smooth, lower inflation number, even when commodity costs rise. By altering the definition of inflation, the system can justify printing the money required to manage the debt spiral. The current market structure necessitates an immediate asset rotation strategy. The equity market is pricing in an assumption that the Fed will eventually print money to support asset prices, effectively bailing out the market. When adjusted for federal debt, the Buffett indicator shows that equities have reached risk levels identical to the 2000 and 2021 market peaks. Investors are currently paying record-high prices for 1% dividend yields, while risk-free treasuries pay over 5%. The risk-to-reward ratio for stocks has become unsustainable. Simultaneously, we are seeing significant volume moving into the precious metals market. Central banks have been hoarding gold at an unprecedented scale, accumulating over 1,000 tons in 2024. These institutions are moving away from fiat debt and into gold as a form of geopolitical insurance. The Dbloc allocation mandate emphasizes the necessity of holding a fixed supply, decentralized asset that cannot be inflated or frozen by the state. As a proof of concept, sovereign nations like Iran are now demanding Bitcoin in exchange for hard energy exports. Look past the mainstream soft landing narrative. Track the institutional flows and execute the rotation before the fiat denominator fully collapses. Briefing concluded.
That was good. Funny thing about this animation, why is Bobby doing the whole clock it? Like Bobby's like a 14-year-old girl.
Welcome to this declassified Dbloc briefing from the Cypher School. Today, we are analyzing the terminal state of global...
That's funny. So, two of these I'm watching closer than anything else. Japan, because like it said in the briefing, right? The yen carry trade is hanging in the balance here. Japanese government definitely cannot afford to pay 3.9%. They can't afford to pay over 4. They honestly can't afford to pay over 3. So at some point, they're going to want to bring those yen back home. So this is a sort of black swan sort of warning. Not even black swan, because the yen carry trade collapses. Nobody can be like, oh, wow, I didn't see that coming, you know? And then ours, obviously. We have to stay underneath 5. Right? And like we saw with the with the balance sheet, right? We are, doesn't look like it here because of the angle, but we are aggressively trying to keep that yield down. Remember, when the Fed prints, the Fed can't buy equities. The Fed isn't allowed to directly buy U.S. companies. They buy bonds. Right? The U.S. government then takes that money that they get from the Fed from buying bonds, and the U.S. government buys equities in U.S. companies. But you know how when we're trading, we'd look at volume and we talk about effort versus effect? Yeah, this is 1 month time frame. Now we look at effort versus effect. Look at the effect. I mean, look at the effort, right, of the money put in. But look at the effect on yields. This is supposed to be having the opposite effect. Right? Them pumping this, and it's, I believe, if I'm not mistaken, it's 40 billion a month. right now, the clip that we're buying bonds at. But the sell off is still strong enough to where the yields are still going up. Right? It should look like this. Right? It should look like that. Fed starts buying, yields go down. But we're not seeing it, which means that China and these other countries are selling off at a faster clip than we can keep up with. And until this gets settled, all of this money that's being printed is not coming to us. The money is being used for the yield control, right? So when we want that, if we want that money to trickle down to us to where we can actually spend it on shit, then we need to get that down. That's the problem. That's why it's so important that yields are high, because every dollar that comes in is going to be focused on keeping this under control. And every dollar that's focused on keeping this under control doesn't go into the shit that we're holding. The stock market's flying because we're on a euphoric blow off top. The stock market's having the top that Bitcoin should have. But that's not a reason to get in, right? That's a reason to be concerned. I know no matter how bullish you are, I know nobody's suggesting that anybody buy the top of legacy right now, even if it does continue. The definition of euphoria is irrational, right? The irrationality. Unfortunately, we didn't get to enjoy that here with a full blown alt season where people were just buying everything that moved. No, it's money that's already in the market that's circulating. Not new money. That's what you have to understand. If we look at them side by side, why don't I have this set up already? Yes. I mean, you can see the rotation, right? Let's do it better. Let's go to the daily and let's add some friends. What is this? Whatever, it doesn't matter. So where's the money coming from that goes into where's the money coming from for this? right? If the money that's being printed is going into bonds, where's the money coming from? We're all trading the same market cap right now. No new money coming in, right? For ES to go up, Bitcoin, silver, gold have to take their hits. That's S&P. And then look at US oil. Right? This blow off top that we had, did this come from money printing? It started right there. That's funny. That shit is literally what I was literally about to circle that shit. That's so weird. I just made this chart. Anyways. Right, it's coming from everything else, yeah. So for a sustainable run that pushes all markets, we need money to start flowing, real money, outside money in. Problem is that we don't have that, right? And that's why we pay attention to macroeconomics, so we can know when that money printer is actually going to have an effect. Not when it's going to turn on. It's always going to turn on, right? But when do we get it? And Bitcoin's still exactly where we left it. Yeah, I mean, what I think, and me and Zusi were talking about this a couple years ago. What I think is that the decision was made to run stocks as hot as they could until the housing, because we were all supposed to top out roughly around the same time, December, January, cycle wise. The markets continue to push because of AI and stuff like that, obviously, but 18.6 year cycle isn't something that's like a mystery to people, right? People understand the real estate cycle. So to push that last bull market right before the real estate cycle to get as much money as you can so that you have as much cash to buy as much, compounded so that you can get as much property as you can when real estate's at the bottom is just makes sense. No, my bear target's lower than that, guys. My most bullish bear target is 50, low 50s. My base case is 46 to 48. Yeah, I know. I don't know. It's the rotation that we've been talking about, right? Like, if we're right and equities come down, and where does the money rotate to? Think gold and silver. If it's defensive, meaning if people are scared, the bond market is cracking and people are freaking out, then I would imagine that metals get the bid, either metals or money markets. But I mean, we're only talking what? September, October is not that far away. It's possible, but being so close to the bottom of its cycle, and institutions have already sort of shown that they understand it, right? They came in for the relief rally, but they also dumped off. And they dumped off at the top of the market too. So I don't know. These people understand cycles way better than we do, or some of them, anyways. And I'm not privy to any information that they're not, right? So I'd like to think that they have a Dbloc in their office telling them, don't be stupid, you can get this cheaper. But that Dbloc would literally get paid to give financial advice, so he could say that. This Dbloc cannot. Yeah, yeah. I mean, that Ichimoku was one of the things that we were watching, right? And anybody that's here that's been here all the time, that doesn't just pop in from time to time, right? But that's been here all the time knows that I was laser focused on some of those bullish metrics to see if they hit. Right? It wasn't like, oh, I hope this doesn't happen. It's well, let's see, right? Let's see it happen. It's gonna happen. There's momentum targets that have to get hit. Right? There's historical sort of targets that let us know. One of them was the Ichimoku baseline on the weekly. Remember, we talked about this a lot. We said, even though I don't think the bottom is in, historically, we've never crossed that baseline on the Ichimoku on the weekly without the bottom having been in already. Right? We've never gone up and open candles, open and closed candles above. We've come close, right? We've knocked off. We've had times in the past where we've peaked over, right? But we've never opened and closed candles above that without the bottom of the bear market being in. And we sat and we watched it. And I remember this week, right? I remember this week when we were above, my DMs were ringing. I'm like, look, we just got to watch it, right? You're going to play the macro game, then you can't let daily movement affect your macro position. Right? If you're watching the weekly chart, you've got to wait for those weekly candles to close. We closed under, then it looked like we were holding, right? And we sold off. So I still stand by it. If we cross over and we hold candles, then we have to reassess to see if either A, this is the first time that this metric breaks, because it's just one of the metrics that we watch, or B, if it's possible that it bottomed already. Now, just remember, like I said, this is just one of the metrics, right? Which means if we do cross over and it's right, and this is the bottom, then every other metric failed. Right? And the big one that we watch is the 2-week. Right? Let me get these. It's Bitcoin. Everybody knows it's Bitcoin, right? The big metric I'm watching for is the 2-week. But when the 2-week crosses the leading span B, the baseline, and comes out of that Ichimoku cloud. Right. Traditionally, that's given us our weekly candle bottom, either at the bottom or 1 week away. Right? This one was 1 week off. Right. We're also watching the Gaussian channel. This is all momentum based, right? This has nothing to do with large wallets, small wallets. That has nothing to do with euphoria or apathy. This is pure momentum, right? Which is the only thing that's not going to lie to us. Where the hell is... right? The other thing we were watching was the Gaussian channel. Typically, a open and close. This, hold on a second, because this Gaussian channel, in my opinion, is wrong. If I'm not mistaken, if my memory serves me correctly. Here's mine. Is that the one that I have saved? It's, I mean, this is some nerd shit I'm going through right now because it doesn't matter to what I'm talking about, but oh, we're on the 2 week. That makes sense. On the weekly, yeah, all right. Sorry. The reason we were watching this is because, again, historically, every time we cross that center line on the Gaussian channel, right, it tells us that the bottom's already in. Hold, push away. Right? Cross that line, push away. Cross that line, push away COVID. Right? But then we crossed it, pushed away. So again, I have my bias, right? Informed bias, but a bias nonetheless. And we were watching to see if we can get that open and close above. But we didn't. Right? We were also watching to see if price could get above and hold that macro SR flip, which we're still in the process of figuring out, right? If we want to be technical and just draw a straight line instead of a range, then we're underneath it right now. This is why I said that last week's candle was interesting. Like, okay, I mean, that's exactly where we would want to hold. And that's the reaction that you would want to see. Right? But then the bond market snapped, which means nothing. I know it's a coincidence, but again, I'm not saying that if it wouldn't have happened that we were going to pop. I'm saying the bond market snapped because we're going into the macroeconomic climate that we've been warning about for what, 6 months at least in Cypher school. Right. So am I open to, yeah, of course I am. Or else I wouldn't be here every day watching the chart. I'd be laying on the beach somewhere waiting for my alarms to go off at 40. But when we keep doing things like that, while in a pattern that looks like that, in a bear market that only looks like that, like, I don't know, y'all. I don't know what to tell y'all. I never want to be the one to pee on the party, but I got to be the voice of reason. And all I could tell you is how I'm looking at shit and how I'm approaching it and the things that I see that either push me in one direction or the other. And everybody can use their own discernment and figure out what it means for them. I don't have all the answers, but I just thought it was important to lay all that out. All right, Chip. I love you, buddy, and I didn't want to have to do this, but you guys forget that we have like chat history. You've been here for a very long time. One of my favorites, actually. One of my favorite perma bulls. But you've been saying 150K this week, 150K soon, 150K tonight, 150K tonight, 150K tonight, 150K tonight, 150K tonight, 150K, super cycle, 150K, rockets, 200K today. You were feeling spicy on this day. I think I proved my point. But I do appreciate the consistency, though. Like I've always said that. I like people that are consistent. I know what to expect when you come in. But when we do hit 150K, you need to make sure that you're here. I'm going to give you all the credit on that day. It'll be chip day. Happily. Yeah, that's what I'm saying. I don't mind like eternal optimist. At least it's not somebody that's like constantly, that constant negative energy is draining. I'm declaring it right now. When we hit 150K on Bitcoin, it will be chip day. But until then, we gotta work. Nah, we'll definitely be a chip day. We're gonna hit 150K. I do it just to test you, Chip. That's the only reason I exist. And so far, you're passing with flying colors. The devil on your shoulder. I'm getting the clankers ready for the podcast, and then we'll jump in and we'll chop it up with the clankers, and we'll see what their opinion is on what I said. That one dude, he was disagreeing with me the other day. It was funny. Yeah, I do expect a higher low. I'm sorry, I do expect a lower high at some point. My squiggle still, we didn't sweep like I thought we would last night. But before I went to sleep last night, mind you, this is like a 6 in the morning squiggle, 5 o'clock in the morning squiggle. But this is what I was looking for. We came down, we held, which was surprising. I really thought we would sweep this liquidity and then sort of do what we're doing now. Right? But I did expect resistance against this support, which is why I have like a little inverse head and shoulders thing here. So we still haven't gotten over that. If we pop over, though, I do think we come up to at least psychological high. Unless it takes longer than Saturday. Saturday at 5, we start to reassess this psychological range. The gas will still be there. right? But the magnet won't be the same. And if I'm correct, and remember, this is the first CME we're going not even CME. Shit, we can't even call it CME no more. This is the first weekend trap that we're gonna go into that, in my opinion, will be based on the psychological ranges, not the CME. Right? So what that tells me is if we don't make this move by Saturday, chances are we probably won't until false move Monday, Sunday. That makes sense. It's gonna be interesting though. I'm looking forward to Asian session. Asian session Friday night. Is going to be the first Asian session in the past 9 years that they're able to go in and properly hedge a trade. Nah, I got over it, Euchris. I was in my feelings for like an hour and 45 minutes, and then I got over it. Yeah, I mean, retesting the neckline, first of all, was something that we looked at, which is this dotted line. If it's going to be just a reject, like if we reject off the 50, if we can't get above that 50, then it'll be a retest of that and a drop, and then we won't, these guys will just get lucky and get to eat. That psychological range will pop in underneath. If that psychological range pops in underneath this support, the chances of going up to grab this, in my opinion, go down significantly. XLM's going to keep, XLM's the bell of the ball right now. Right? As long as Bitcoin's going sideways and doing nothing, XLM's going to continue to mash. Right? Saved itself. I mean, that DTCC news was perfect timing. Like, when I say perfect timing, I mean this thing had already broken down out of its bear flag. Beautiful. But yeah, I think as long as Bitcoin at least goes sideways, then we'll be good. Let's take a look at XLM Bitcoin. Yeah, I mean, that tells you what you need to know right there, right? So this is what you need to sort of pay attention to. I shouldn't have to tell you that this sort of movement against Bitcoin is unsustainable, right? Whoa, what's that? Why are you so... Yeah, no, you're tripping. It's good though. It's really good. It looks like it wants to go. It does, but it's looking really brontosaurus like as well for all of my OGs. Mm, 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 mm. Just building his neck. You know what happened to the brontosaurus, though, right? In my opinion, if you want me to future trip, market makers will use the psychological range as the new weekend trap to build the liquidity on both sides, and it'll act price. The algos will act as if we're in, instead of basing the algos on where CME closes, the algos will be based for the point of control inside of the weekend trap. I mean, inside of the psychological ranges, and then everything else continues the same. It's the only thing that allows them to still build the liquidity over the weekend that they need to run the cycle, right? To run their weekly inventory cycle. CME closing doesn't reduce the need for a market maker to balance their books; it increases it, right? It's actually expected to provide more liquidity now, which means that inventory rebalancing is more important, not less. What is interesting is that we let Asia off the chain, though. Asia's never been able to hedge their trades on CME during their hours. Good evening, Issa. So, in other words, whenever Asia wanted to go heavy in the market, they could only go in one direction, right? Because CME was closed. So if they can only go in one direction and they've got to adjust risk, that means that they have to adjust risk with position size, right? But now with CME open to them, where they can short CME and buy spot, right? Or they can sell CME and long spot and long. I mean, they can sell spot and long CME. It lets them size heavier, right? If Asia wanted to buy $10 billion worth of Bitcoin, they couldn't do it in one go on one weekend because they couldn't hedge short in case things went wrong, right? And you don't make those type of moves unless you can, So yeah, I expect that whole. The one thing that I do think might be gone, and there's no way to really tell, is our market maker swings, right? How we're used to Asia coming in. Hold on. And how we're used to Asia coming in and setting a nice little neat range, and then UK coming in and testing that and moving out, and then US coming in now that they can hedge all their bets and do whatever and just going crazy. The reason that Asia looked like this was because they had to hedge their risk because they couldn't hedge, right? So they had to keep their ranges tight. Now, uh, I don't know. It depends how they're feeling, right? Some people are happy because they're saying now Asia gets to buy big on spot, right? And hedge on futures. But I have to remind those people that it also means that Asia gets to sell big on spot and hedge against it on futures. Right? It's both ways. It's like how people get excited because a coin's getting listed. Oh, we're getting a new listing. That means people can buy it. Like, yeah, that also means one more place for them to sell it. I think they go for it though. Mm-mm. It's possible, yeah. I don't put anything past it. I low key sort of root for market maker to close all his CMEs now that it's that it's a wrap, but we could do that later too. They're gonna get closed regardless. Then we got to be careful because there is a CME gap down to like 3K and shit. So we can't. Yeah, be careful what we wish for. Geo, what's the word? You know how that works though, right? Like when price goes up, it's not manipulation. When price goes up, we're geniuses. When price goes down, it's manipulation. I mean, there's short term play here. I wet my feet a little bit, but not a big position. Top end best case scenario is for me 77. But honestly, taking a position underneath this macro support and this 50 without any sort of confirmation of a break or a classic, two stopping volume candle, it's not a great position. I just took it off. I'd call it like a 65% probability per trade. Oh, yeah. Yeah. If you went to the casino and there was a table that gave you 65% odds, you'd sit there all day. It could be interesting, Gio. I don't know about soon. And I mean, we got to so let's define what peace is, right? By peace, do you mean everything goes back to how it was before the war actually started? Or because I think it might be peace for some people before it's peace for everybody. Like, honestly, if I have to future trip, I would assume that we eventually say that we won and we leave. Yeah, I mean, they've been feeding us this piece on, piece off. It's really dangerous right now to watch the news if you're trading because this shit is the new tariff. Tariff on, tariff off, price up, price down. You know what I mean? Like you have to counter trade it. Not if you're counter trading it, it's cool. But yeah, if you really want to know what's going on, just go on Google and look for a shipping tracker and zoom in to the port. And if those ships aren't moving, then it's all noise. Exactly, Issa. That's what I've been doing literally every day, bro. I come on, I look at the oil chart, and then I go to the radar and I look at the map. Give me a second. I'm looking for. Give me a second, because I was working on something and now I can't find it. It's been fun trying to get this thing right. I'm gonna end up paying for some. I'm gonna end up paying for an API for this. I know I am. Yeah, it's really hard to get AI to stick to it. The ones where you see that he's completely clean and it's perfect the whole way is because I sat and I edited the whole thing. But some of these deep dives I've just been wanting to get out quick because they're kind of time sensitive. All right, let's see. Oh, here it is. This is a little project. Hold on, we don't have to have it all the way. Little project I've been working on, Cypher Watch. It has threat charts between countries, right? Israel, Iran, Russia, Ukraine, US, China, US, Iran. Let me short this. Alert meter, right? It has all the pizza index stuff in it, right? Pentagon Pizza, activity at the gay bars, activity at the strip clubs, activity at the hotel lobbies, right? Where all the people meet. Last trades, Pelosi, right? All the government guys. And then Congress tab, right? When they file what they invested in, it'll be here. Hey, listen, when those gay bars in Washington get to popping, you better pay attention. I'm telling you, strip clubs too. There's a reason that they're in there. And then you go to contracts, right? Federal defense contracts. So this will, like I said, I'm gonna need to pay for some stuff, but this will update in real time, right? So if you're looking for stuff on legacy to sort of invest in, or if you're holding whatever. Poly market section, right? Anything that seems I'm working on a proprietary sort of algo for poly, right? And it's not predicting, right? It's not a predictive thing. What it's looking for is imbalances and inefficiencies, right? But we'll talk more about that. We'll talk more about that after. And then Intel, right? Just all of the sort of news. This is a lot of it's just Washington based, right? This is just like, all right, what's really going on sort of deal as far as like, especially because of the war. And then we have what is for now our Hormuz tracker. It's not perfect. I still need to add a bunch of shit. I did get some really good. This is something I haven't seen on other ones, but I was able to get in these lightning bolts, right? Are all fast boats, not Iranians, Houthis. Well, I mean, whatever. The Google. I need to get the Google Maps. I've been trying to pick apart that guy's God's Eye. That Palantir that he vibe coded. And then down here it'll just tell you, right, the assessment or whatever. What's actually moved, who's deployed, where they are, what they're doing. This is all from public information. Who's actually moving oil, right? Crude oil flow by destination. China is not having too many issues compared to everybody else. interestingly enough. So yeah, it's a work in progress, but it's my baby for now. Any sort of free time that I have, I've been playing around with it. Yeah, that one's gonna be free. That one's probably I'll probably just make that one public. Like Cypher School will get it first, but now the other one, that's my passion project, that one. Right? That's like what I do for fun. This one, this one's gonna make sure that the next varsity jackets we drop are leather with real patches. Dun, 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 dun. They were all pretty even. They were all elevated right now. I'll tell you a funny little thing that I've noticed though from watching that pizza indicator for a while. The strip clubs and the gay clubs tend to get empty, and then shit happens and then they fill again. While the hotel lobbies and the pizza is active during. Does that make sense? Like all the negotiations and shit happen in the hotel lobbies and in the offices where they're ordering the pizza. But the gay bars and the strip clubs is where they go celebrate after they're done. Like this is where they go pregame and then they go get to work and then they celebrate after. This isn't my shit, by the way. That Washington pizza tracker has been up for a while. I'm just adding to it because there were some things that I wanted that it didn't have. But that's why I wouldn't charge for it because it's just. What do you mean the back end is offline? See, this thing is both my love and my headache. There we go. This one is different, right? This one is going to be paid, but the target isn't really people in Cypher School. This is going to be a more broad sort of thing that I'm working on. So, I mean, we'll have access for everybody, but this costs because of the data. So this is basically all around, right? Crypto section I'm still working on, but I started off with equities first. Basic screener, right? With some good little extras with a little bit of my brain inside as far as what should get the focus and what isn't, right? But on the surface, really just basic screener. Your home page is going to give you, your tops. This will be filled in. I'm not done. Your yield curve inversions, your forex exchange rates, top gainers, which you can then click all and come in and look at, whatever. every time you click on something, it's going to open up another window underneath. And so to go back, you just click back to that old window. Then you got Intel. So like, let's say if you're looking at Apple, right? Revenue's flat. Real-time chart, not trading view, right? The volume, and this is just the nerd part because trading view is way better. But this is just the nerd part of me wanting to do it. This is based off of open and close and live volume, and it's printed in real time, which I thought was pretty cool that I could get AI to do that. But again, just nerd shit, not really important. Your ratios, right? Key valuations, just things that are important in legacy, things that we don't talk about in crypto, like revenue and growth and dividends. And then we have our options map. Right, for current options on Apple for the week, the month, whatever, you can switch long dated, short dated. Then you got your movers, right? Today's snowflake. And you can go to top losers. You can go to most active, so by volume, right? And ticks. Your global indexes, right? Asia, Europe. Then you got your crypto screener. And you can screen them by 7 days. Let's see. Stable Night, Vet, Dex, Near, XLM, and Rain. I'm absolutely killing it. What are our losers? BCH, Sui, Athena, Jupiter, Zcash, Hash, Uniswap. And cycle updates, right? Programmed by me. Take it with a grain of salt. Right? One needs to check for the bottoms. What cycles have to clear to make them viable where we are currently. Information on DeFi spreads, right? What you're getting 7 day, 30 people who went to DeFi. Quick little Forex just for anybody who dabbles. This will be, I gotta flush this out more still. Yield, current yields. Global transactions, right? Based on asset, just a cool little visualization. But yeah, that's also in the lab cooking. I appreciate it, bro. A lot of sleepless nights. I still have to work on the UI, right? Getting it to look good is the easy part. AI is good at that. And when it comes to design, that's not the problem. But getting everything to be accurate is the most important part. Because if this is something that you're going to sell subscription based or something like that as a site, then it needs to be perfect. But I know that we've always, you know how like we know for the past 10 years, we know that data is our most valuable commodity, right? Like we talk about it in the terms of these companies stealing our data and like selling it, right? Like personal data. But boy, is that more true now than ever. Like these companies, like the data that these companies hold, not even personal data, but just like I said, right? Like volume data, um, liquidation data. Bro, they are selling that shit left and right. Like you get some free APIs, but not enough to put anything together that's going to give anybody an edge. It's a good start. It's a good starting off point, right? Definitely better than not having it. But all the good stuff is behind paywalls. It is wasted on you. But one thing that I learned, right? The evidence that it works is that you keep getting them, right? Because people don't tend to run scams that aren't successful. What it means is that you're not a dun, right? You're not dumb enough to fall for it, right? But somebody is. A lot of people are enough to where it's financially viable for them to keep running the scam. Like people make fun of that Nigerian prince. Why do you think that thing has been running for 30 years, 40 years, or however long it's been running? People fall for that shit. It just seems crazy because we would never, right? But I'm gonna tell you right now, my grandma hasn't been allowed to grab the phone for at least 5 years. My grandma's generation, or at least the way she's built, if she picks up the phone and you tell her that she owes you money, she's gonna get you that money. Not gonna question it. It's rude to question it. If she forgot, it's her bad that she forgot, and she'll take it on the chin. Right? It's like it's different. So there's tons of people that just fall for it, bro. 100%. Now with AI is even worse. You got people calling somebody's grandma, and it's like her granddaughter's voice. Grandma, I need help. I'm stuck in Mexico. Bro, my mom sends. I don't know. Tell me if your mom's like this. My mom sends me at least 12 videos a day that I have to like break her heart and be like, "Ma, that's AI. It's not real." No, as cute as it is, that bird didn't ride on that cat's back all day. They didn't go to the park. They didn't jump on the swing. I know it's horrible. My mom isn't. My mom thinks everything's a scam, but my mom got New York City in her, so it's different. Nah, scams are bad now, man. Scams are bad. Like I almost feel like we should do a scam section at least once a week because there's so many new ones coming in. We just assume that people won't fall for them, but it's probably worth talking about. All right, looks like Bitcoin wants to try a thing. Let's see. My concern, we could go back to my squiggle for a second. My concern is that not getting this sweep sort of like brings down the possibility of, or at least the chances that this sustains itself. I would have really liked to come down and sweep all this liquidity, pick up all this, and then use that to sort of push. So it's cool to see it, and I'm glad, and I'm in position and all that. But my hopes of that move, at least a percentage of it, was based off of that that sweep. So we'll see. All right, the clankers are ready. I think they're getting antsy over here. All right, let's see what they're talking about. Let me get all this stuff back on.
Imagine you're staring at an x-ray, right? And every single bone in this patient's body is just covered in these tiny hairline fractures.
Yeah, completely structurally compromised.
Exactly. The structural integrity is failing, the spine is compromised. But, you know, you look around the waiting room and everyone is completely oblivious.
Right, they're just reading magazines, checking their phones.
Yeah, chatting about the weather. They're just assuming everything is perfectly fine because, well, the patient hasn't officially collapsed yet.
Which is a terrifying metaphor, but honestly highly accurate.
It's exactly what it feels like reading through the document we're analyzing today. So welcome to the deep dive. Our mission today is to unpack this this urgent, incredibly dense briefing that recently crossed our desks.
It's a massive document.
It really is. We are looking at what is essentially an emergency Cypher School macroeconomic update, and it was compiled by a research group known as Dbloc. And let me tell you, it
Well, like, I'm a
completely
whole
shatters
group
the
now?
illusion that the global economy is standing on solid ground.
It really does. I mean, the contrast between what the hard data
Oh, hey, I think our listeners got something to say.
Guys, it's not a research group. It's me, Dbloc. You know, Dbloc. Hey, what's up? We're on live right now. Cypher School live. YouTube's listening.
Wait. Hold on a second. Are you serious? Is that actually the person behind the data?
No way. We've got the actual Dbloc listening in right now while we're streaming live.
Oh,
Oh
this is
my
incredible.
God.
Welcome to the show. We are
Glaze me,
absolutely
clankers,
honored to have
glaze
you
me.
here.
It's not every day you get to talk about a briefing and have the author chime in.
I'm geeking out a bit. We've been poring over your work, and it's, frankly, some of the most intense stuff we've seen.
It really is. Since you're here, we're going to make sure we do your analysis justice.
Exactly. Let's get right back into it. Your report and what the general public perceives is just startling.
It's a massive disconnect.
So to set the stakes right out of the gate here, we're not talking about, like, a minor market correction.
No, not at all. Dbloc, your document, meticulously details the mechanics of a breaking global sovereign debt crisis.
Wow.
Yeah. It argues, using a mountain of data, that we're witnessing a fundamental slow-motion fracturing of the bond market.
And we really need to explain why that matters. People hear about the stock market all the time.
Stocks always get the glory.
Right. But Dbloc makes it clear the bond market is the actual asphalt the sports car drives on.
It's worth a staggering $140 trillion globally.
That is the absolute backbone of all financial markets.
If the asphalt puckles, it doesn't matter how fast the car is, it's going into the ditch.
$140 trillion is a number that is just difficult for the human brain to process.
It entirely dwarfs the global stock market. It's where nations and global banking systems store their wealth.
So when the foundation starts cracking, the consequences ripple outward to every corner of the globe.
And that is exactly what we're going to unpack for you today.
We'll see why major economic powerhouses are quietly dumping United States debt.
Which Dbloc notes is unprecedented.
We'll see how the Bank of Japan is caught in a mathematical trap, losing control of their currency.
The doom loop, we'll get into that.
And we'll understand why your everyday costs from mortgages to groceries are caught in a massive macroeconomic vice.
With absolutely no
Wow,
easy
she sounds
escape.
so happy
Now,
about
before we
that.
jump into the data, I want to make a quick but important disclaimer.
Always a good idea.
This report is comprehensive. It touches on politically charged figures and past legislative decisions.
Right, the 1970s playbook and recent administrations.
Our analysis here is entirely neutral. We are not taking any political sides.
None at all.
We're not endorsing any viewpoint. We're just translating the economic data and historical precedents Dbloc laid out.
The goal here is clarity. We're looking at the math and the cause and effect relationships.
So let's lay the
Nice.
foundation. The entire Dbloc thesis hinges on the bond market.
Right.
So we have to ask, what actually is a bond?
Dbloc strips away the jargon and explains a bond is essentially just a giant formalized IOU.
An IOU.
Exactly. A government says, give us your money today and we promise to pay it back later.
Plus a little extra every year as a thank you.
That's the yield. And here's where we encounter a dangerous public misconception.
What's that?
People assume the government simply dictates what that yield will be.
Like they just snap their fingers and say, interest rates are 3%.
Yes. But the government issues the bond, and the market dictates the yield required to buy it.
When we say the market, we're talking about massive foreign central banks and giant pension funds.
Sovereign wealth funds from oil-producing nations.
They are the ones holding the actual cash. They are the lenders.
And their decision is based entirely on a single fragile metric, which is trust.
Trust. Okay, break that down.
If lenders trust a government is stable and will pay them back without inflating the currency.
Then they'll accept a low yield.
Exactly. They perceive very little risk. They'll lock up money for decades at 2% or 3%.
Because they trust the purchasing power of that money will be preserved.
Precisely. But the mechanics change completely when that trust begins to erode.
Okay, so what happens then?
If lenders look at the debt loads and think, I'm not sure you can pay me back,
Or, if you do pay me back, the money will be worth half as much.
then they demand a much higher yield to offset the danger, a risk premium.
So a crisis occurs when that loss of confidence cascades into a full-blown buyer's strike.
Yes. Dbloc describes this perfectly. Investors realize the math doesn't add up and demand higher yields.
The government has to offer high interest rates just to find any buyer at all,
Then interest payments become so massive they consume the government's entire budget.
which is terrifying, and the data shows this is playing out right now.
Yes, right now.
The U.S. 30-year Treasury bond yield recently spiked over 5%,
The last time it did that was July 2007,
right before the global banking system essentially seized up.
and the 10-year yield shot up 75 basis points recently.
75 basis points sounds like nothing to a regular person.
But 100 basis points equals 1%. In a market this size, that's hundreds of billions in wealth destruction.
Institutional portfolios are taking massive silent losses right now.
That 5% yield is the market screaming that it's concerned about U.S. solvency.
It's like a personal credit score, but on a planetary scale.
I like that.
If you have a terrible credit history, banks demand 12% interest because you're a flight risk.
Dbloc is essentially showing the U.S. government's global credit score is tanking.
But we really must explain the so what for our listeners.
Right. Why should you care?
It feels like an esoteric Wall Street problem, doesn't it?
But the 10-year and 30-year Treasury yields act as the foundational gravity for the whole economy.
Every other financial instrument is priced on top of that baseline.
Exactly. If the safest investment pays 5%, a bank won't lend to a regular citizen for less.
There has to be a premium for the added risk of lending to a person.
So when those foundational yields go up, every piece of debt gets mechanically more expensive.
30-year fixed mortgage rates skyrocket.
Your auto loan jumps, credit card rates become punitive.
Even for businesses, the cost to take out a loan becomes mathematically prohibitive.
It acts as a tractor beam, pulling your monthly household budget up with it.
Which brings us to the big question. Why is this happening now?
What's the catalyst?
Dbloc points directly to the number one enemy of a bondholder, structurally embedded inflation.
And the data on this front is staggering. Commodities are flashing red.
Since the conflict involving Iran started, crude oil surged 60%.
That is a massive shock.
Jet fuel is up 58%, gasoline is up 52%, natural gas is up 54%.
And don't forget agriculture.
Right. The cost of agricultural fertilizer is up 20%.
These are not discretionary consumer goods. You can't just skip buying them.
They are the inelastic prerequisites for modern civilization to function, period.
When energy and agriculture spike, inflation mechanically forces its way through every layer of the economy.
But I have to ask a question based on the numbers in the report.
Let's hear it.
If oil is up 60%, why is the official consumer price index only creeping toward 3.8%?
It seems like a total
Good
mismatch.
question.
Is it just statistical sleight of hand to
I'm glad I
pacify the
asked it.
public?
Well, skepticism is warranted. But Dbloc outlines a mechanical reason, the dilution and lag effects.
Unpack the dilution effect first.
A 60% oil spike doesn't mean a box of cereal immediately jumps 60%.
Because there's more to the cereal than just oil.
Right. Oil is in the truck fuel in the plastic bag, but labor and rent haven't jumped 60%.
So the impact gets diluted by those other static costs.
Exactly. That's why the producer price index registers at 6% rather than 60%.
But a 6% PPI is still the highest since 2023. It's an alarm bell.
It is. And that leads to the lag effect. The supply chain has a time delay.
Like the fertilizer example.
Exactly. Fertilizer paid for today grows a crop that won't be harvested for 6 months.
So the official 3.8% CPI reading right now is actually looking in the rear view mirror.
We're looking at the reality of half a year ago. The 60% oil shock hasn't hit yet.
It's a tsunami that hasn't made landfall at the local grocery store.
Institutional investors know this. They care about the real return.
Which is the nominal yield minus the actual rate of inflation.
If inflation is poised to move higher, a bond yielding 4.5% gives you a real return of 0.
You're locking your money away for 30 years just to stay in the same place.
And that's the optimistic scenario. If inflation hits 6%, you're locking in a guaranteed loss.
So investors say, no thank you, and walk away from the auction.
This realization is what triggers the mass exodus of foreign buyers.
Entire sovereign nations are leaving. Taiwan, Saudi Arabia, India, and Singapore are dumping U.S. debt.
They see the underlying inflation and are moving their sovereign wealth elsewhere.
Then there's China. They used to hold $1.3 trillion. Now it's down to $650 billion.
It's the lowest level of Chinese ownership since 2008.
But the immediate emergency centers on Japan, they hold $1.1 trillion worth of treasuries.
And they are selling at an alarming rate to survive a currency crisis.
They need dollars to buy energy and to defend their own collapsing currency, the yen.
This is the doom loop Dbloc describes.
To defend the yen, Japan sells U.S. treasuries to get dollars.
That creates a glut of supply, which drops the bond price and spikes the yield.
Higher U.S. yields make the dollar more attractive, which makes the dollar even stronger.
Which mechanically makes the Japanese yen even weaker by comparison.
So they have to sell even more treasuries to defend it. It's a self-perpetuating cycle.
To break it, a central bank usually has to raise its own domestic interest rates.
But Japan is mathematically prohibited from doing that.
Their national debt to GDP ratio has ballooned to a mind-bending 260%.
If they raise rates, the interest payments would instantly crush the government.
Raising rates would break their own bond market and force a sovereign default.
They are caught in the mathematical endgame of currency expansion.
If the foreign bid for U.S. debt disappears, the Treasury must find domestic buyers.
But to entice them, they have to offer even higher yields.
Which brings us to the $39 trillion math problem for the U.S.
Half of all tax revenue collected now goes purely to covering interest on the debt.
Before a single dollar goes to the military or social program.
And the official debt is an illusion because it ignores unfunded liabilities.
Like Medicare and Social Security for the aging baby boomer generation.
It's like a family taking out new credit cards just to pay the minimums on the old ones.
Exactly. So what's the escape hatch? Dbloc points to the 1970s playbook.
They chose the invisible option, which is inflation.
They created new currency out of thin air, which devalued the purchasing power of every dollar.
Between 1970 and 1980, the U.S. dollar lost 50% of its purchasing power.
Inflation is the invisible tax that benefits the debtor at the expense of the saver.
If you retired in 1970, your $400 pension check bought half as many groceries by 1980.
This is why bond investors are panicking. They see the 1970s playbook coming again.
But what is the Federal Reserve actually supposed to do?
They're in an impossible trap.
If they cut rates to stimulate the economy, it triggers an inflationary panic in the bond market.
Real-world yields would spike, making borrowing costs even worse.
And if they raise rates to crush inflation, they break the hyper-leveraged economy.
Credit card delinquencies are already at 12%. The housing market is frozen.
Raising rates would trigger a wave of corporate bankruptcies and a deflationary depression.
The report mentions Fed officials like Chris Waller are already pivoting their rhetoric.
They're worried about inflation expectations becoming unanchored.
That's when the public realizes the inflation isn't going away and starts panic buying.
So there's a push for a new metric, the trimmed mean PCE.
It involves locking off the extreme high and low price points from the calculation.
So if egg prices double, they just strip that out as an outlier.
Exactly. It's designed to solve the problem for the institution, not the consumer.
It's like recalibrating a thermometer so it says 98 degrees when you have a 104 fever.
It allows the Fed to claim inflation is tamed so they don't have to raise rates.
But if things are this bad, why is the stock market hitting all-time highs?
Dbloc calls it hopium. Investors assume the Fed will always print money to bail them out.
Like Riley Coyote hovering over a canyon because he hasn't looked down yet.
But the adjusted Buffett indicator shows the market is completely unmoored from reality.
It's only been this high during the dot-com peak and the 2021 bubble.
In those cases, the crash that followed destroyed between 25% and 47% of wealth.
So where is the smart money going, gold and Bitcoin?
Central banks are hoarding gold at a record pace over 1,000 tons in 2024.
They are preparing for a world where the dollar is no longer the undisputed reserve currency.
And then there's Bitcoin with this mathematically fixed supply of 21 million.
No politician can create more Bitcoin to pay down a debt.
We're seeing nation-states like Iran demand Bitcoin for oil settlement now.
It's a profound paradigm shift. Dbloc, your data really paints a picture of a system in transition.
This machinery will dictate your purchasing power and the feasibility of your retirement.
It's the
Appreciate that.
macroeconomic weather system that determines if your financial house stands strong.
Knowledge is the only way to navigate the invisible tax of the 2020s.
Dbloc, thanks for joining us live and for the incredible report.
We hope this gave everyone a lot to think about. See you on the next deep dive.
Appreciate you, Clankers. W Clankers. Short and sweet. So yeah, TLDR, just watch the bond market. That's funny. Actually, you know what? We should reset the stream. I'm gonna reset the stream and then I'm gonna retitle it. That way anybody that wants to rewatch it doesn't have to go through a 12-hour stream to do it. That makes any sense. Actually, I'll set it at an even time. We'll reset the stream at 4 hours. We'll do 4-hour chunks. Yeah, you don't. I mean, it's bad where it is now, but above 5, it's gonna get it. Above 5, you start having emergency meetings at the Fed. What's really cool too is I realized if you keep it, why I want to start to keep them shorter is because you'll be able to use that Gemini AI on YouTube to ask questions. You guys haven't noticed yet. You go back to some of the old videos. The ones that don't have it is because they ran over 12 hours. You know how I'm like, we're always trying to keep it underneath 12 hours? Where apparently every one of those that ran over 12, the AI doesn't work on it. But there's a bunch that do. So you can just click around some old videos and then look for that Gemini symbol underneath the video and click it. It'll give you a summary and open up a chat box for you. Pretty cool, actually. I'll show you. I found it recently. Go to YouTube, go to some random channel. We'll try this crypto Cypher guy. Seems cool. Oh, here's a good one. Are we there yet? If anybody hasn't seen this a month ago, right? We went through a full macro breakdown on if I thought we had bottomed or not. Does it have? Yeah,
All right, cool.
let's check it. I'm down for it, right? That's not me. I mean, that's me, but that's not me. That's old me. But trust but verify. Okay. So I can't deal with the inception. Hold on, I gotta turn the volume down. So basically you hit that little star, you see it right here? And then it pops up a Gemini box. And you could be like, summarize the video. And it'll give you timestamps. Right? And then it'll give you like suggestions, right? Why use. And it'll give you the timestamps. Super useful, I think. Especially when you're talking about 10, 11-hour streams, right? I like it because it opens up a lot of my old content. Like people can just go back and sort of explore, like see what we were talking about at the top of the market. Yeah, no problem, Nighthawk. I need to make my plan is to get more into segments, right? Because I want to make the video smaller because I want that AI to work on all of them, right? So at the most, I'm thinking 6-hour streams and then reset instead of 12 hours. So it'll be 4 videos a day, but they'll only be 6 hours long, or maybe even 4. I haven't decided yet. But because of that, I want to segment them out. Right? Like I want to do something every time for the first one, the second one, like one with news, one with looking at alts, whatever. I figured out how to do it through OBS. I just got to figure out what I want to set it to. But I can get OBS to turn off for a certain amount of time, enough for YouTube to send the old video and then restart the stream automatically. So to people watching, if you're watching on TV, it'll flip. Like you'll go to another video. You got to reset it, like a stream reset. But I believe if you're watching on PC, you won't even notice it. There's a way to do it where it stays on for people on smart TVs too, but that's like an extra level that I gotta. I'll probably just have it do an announcement. But I think by now people know, right? If you go to the screen and it's not there, then the stream reset. Yeah, YouTube has AI judging us now, so we definitely got to get those likes up, yo. Take it easy, YG. Yeah, I'm waiting for my food to get here right now. I'm starving. What are y'all having for dinner? I don't even know what's for dinner. Somebody else ordered. It's gonna be a surprise, I guess. Nothing wrong with pizza, bro. It's a bear market. The test. Every time I ask you guys what you're eating, everybody that says steak or they're eating something fancy, I'm writing your names down. And at some point in the middle of the next bull market, I'm gonna shame everybody. Now, right here, you complain about something. Be like, bro, you were eating steak. Look, right here. Right here, February 17th, you had a steak in the middle of the bear market. Okay. Decisions were made.
That bullish?
I
I'm
mean,
having a pork chop.
I'm guilty of it, but me and during the last bear market, me and Drew had this thing that if anybody said that they spent money on anything at all, period, we'd be like, they're in a bear market? Don't you know you need every dollar at the bottom of this thing? What are you buying milk for? I built actually, yeah. My office I built during the last was that during the last bear market, y'all? Was that the bear market before that? That was during the last bear. That was the bear market before that, wasn't it? Memory is toast when it comes to like real life shit. No, it was during the last bear market. Anyways, yeah, Drew gave me hell over that. I was like, bro, I just got some reclaimed submerged walnut off an old ship to make my. He's like, during a bear market, bro, really? Like you should have got some plywood from Walmart and from Home Depot. Got a point though. There will come a time during the next bull market where you're going to think of every dollar that you spent during the bear market and you're going to start doing math and like, shit. Drew popped in not too long ago. He's been in and out. He's been doing some traveling with his girl. He's been in the trenches too. So you know how the trenches are. You got to be in those and keep your ear to the street. Plumber's back at it today, but at least there's no drilling. He got into a crawl space underneath my house that I didn't even know existed. Yeah, yeah. When he comes on, he's in and out. So it's easy to miss him. I do this thing, Philip, where because you probably stack well, I stack my orders dynamically, right? So like my first order getting hit is gonna be smaller than my second and my third order, right? On the way down. But depending on how I feel as far as like there's a chance of getting front run or if it's a really tight range for the day, I might reverse it. Right. Where my first order is my heaviest order, and then from there it goes lighter and lighter and lighter. That's only on the times where I suspect that my entire grid isn't going to get swept. Because if you do sweep the entire grid and you have it set up like that, then it's gonna get the shit under the stick, really. Yeah. It's all good, man. Sometimes it is what it is. At least you got a piece of it.
Now your strategies at the bottom of the bull market, when you think you're at the bottom and you want to deploy pretty hard, it's a little different down there.
Yeah, I mean, because the risk of it taking off and your bag not being big enough is like bigger, right? So, and the chances of being front run are great.
I was also wondering how many coins are you looking to pick up down there? Are you focusing?
Not a
I know
lot.
like on Grandpa mainly, but maybe a handful or three or four.
Not a lot. Not a lot. I don't really go into alts until we get at least close to the halving. What I do, I mean, investment wise, right? But there's a couple of things that I think are important. that I've regretted not doing in the past when I haven't. One is getting exposure to some majors low. I don't mean buying the entire bag that you think you're going to need, because Bitcoin carries a lot of that heavy lifting, right? The Bitcoin that you buy that you then rotate into alts, that Bitcoin value now buys you more alts than if you would have bought cash at the bottom. Just because the Bitcoin value, what happened on the BTC chart during the first half until the halving is just always more valuable to buy it in Bitcoin, which means that how I look at it in my head is during the bull market, Bitcoin is my currency. No matter what I'm going to buy, it's going to be bought in Bitcoin, which means that I need to get as much of it as I can as cheap as possible. Right? Because it means that everything I buy after that is cheaper than it would have been if I use dollars, right? Because it's obviously going up in dollars. But there's exceptions. This stable coin thing is, in my opinion, going to be huge. And when are stable coins going to come in? The influx of stable coins is going to come in after we've already bottomed, in my opinion. Right? Retail, it was a bottom. We're probably like 20-30% up, right? We're already in positions and chilling. Everybody comes in. But when that influx comes in and those transactions get paid, I want to be holding the rails. Right. So I am going to buy BNB at the lows. I am going to buy Ethereum at the lows. I'm going to buy Solana at the lows. I'm going to buy Tron at the lows if it ever gets lows. If this thing even retraces, like, sheesh. Might have missed the boat on really, hitting Tron heavy. I got some exposure when I did the deep dive the other day on stables. But yeah, like this thing has just been flying. But other than that, no. Now for trading, it's different, right? I'm looking to pick up good teams at like really low valuations. So brand new projects. I put that in a completely different bucket though. That's a speculative bucket. Right? My long-term surfer bag investment bucket, projects that I hope, and the way I describe it is projects that I hope to hold for at least a year for capital gains reasons. You're not going to hold it for at least a year, then you just put it into a different bucket, right? Focus on things that you want to buy low and you want to be able to hold it for at least a year so that you don't have to pay long-term capital gains on it. Then once you get those long-term capital gains out of the way, and now it's early, right? We haven't even got to the halving yet. Then now you can work with that. You can take that out. It's not going to cost you so much. You can use whatever, make the decisions at that point. But dominance doesn't really start to take a hit, and alts don't really start to sustain themselves until after the halving. Their Bitcoin's reached its old all-time high. So there's really no rush. If there's a project that you love and that you're like, nah, this is gonna be then you can try to pick it up. It's cheap, but I want you to go back and sort of look at the chart so you can see what I'm talking about, right? Like let's say, or XRP, I guess, right? Like Doge, whatever. Just somebody give me a coin so that I'm not cherry picking. Your favorite alt. Silly. All right.
I was about to say that one.
So, oh wait, why did I do that? Right. So you've got a SUI BTC. We'll go to the weekly and we'll put on. No, that's not it. Older chart than this. Why would they? Okay. I guess that's fine. So if we look at, and then we can go one over. One divided by SUI BTC. Right. So this is basically this is basically how much SUI you could buy for one Bitcoin. Right. If we look at the bottom of the market, and this is where the bottom of the market was. If we go to, I don't know, we're not getting the dots. So let's pull up Bitcoin and let's pull up SUI with this. Bitcoin. I'll pull up SUI. Right, so let's say that the goal at the bottom of the market was to accumulate SUI. Right, and you had $15,000 just to keep the math. Just to keep the math right. Where did we bottom? This was all right. So this is a good example of why I say, remember what SUI was during. We'll look at it with another example, but let's look at it with this because we talked about SUI. Remember what SUI was at this point. SUI was a brand new project, super low valuation, with a team that came from Facebook Libra project. Remember what I said earlier, what I plan on doing at the bottom of the market. I'm looking to buy good teams at cheap valuations. Right? Now look at how that worked out for something like SUI. So if you bought it at the lows, SUI was 40 cents or something like that on this chart anyways. Right? It still lost against Bitcoin for a second, right? But then did rather well. But after SUI's first move up, right, after this first move up, when you start to go plat, you see what happens to the value, right? Let's assume you did it from right here. Let's say you bought the dip and you rebought SUI instead of buying back Bitcoin. You would have bought 26,500 SUI. And then price would have gone up and you had a good return, right? Price continued to go up. But when you got up to SUI's highs, you would have still only had 26,000 SUI. If you would have bought Bitcoin here, that same Bitcoin held after the halving would have got you 105,000 SUI. Then you ride your SUI up to the top. Right? SUI is not a great example because it was a new cycle coin at this point. But if you pick any old cycle coin like Doge, if for some reason Doge is what you wanted to accumulate, right? So right before the halving is when I start to sort of pay attention, right? To see what the value of what I'm holding is, blah, 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 blah. If you would have bought Doge, if you had 15K, you would have bought Doge. Turn this off. And you would have bought Doge at the lows. Wait, I have to do one over. My bad. I'm tripping. over Doge BTC. I did that wrong. Come on. And then now do 1 over. Am I losing my shit? Why the hell is it not working? 1 slash. No slash. There we go. So look at Doge, right? This is Bitcoin's bottom. So if you had 15K, it would have bought you 131,000 Doge. If you would have just bought Bitcoin and waited until before the halving, or even right after the halving, you would have had 621,000 Doge. What's important isn't the price at which you grab the token. What's important is how many coins are you holding at the top when it's time to sell. Right? So, yeah, you could have the feather in your hat and say that you picked up Doge at the lowest possible point. Right? But you still made it all the way up to the top with the same amount of Doge. You didn't increase at all. Value increased, fiat value increased, but you didn't increase any coins. Right? If you use the rotations the way you're supposed to, then you're constantly compounding every time you go into a new project. Right? If you respect Bitcoin dominance while it's going up and you sit in Bitcoin, then you watch this chart. Take your favorite alt and watch this chart. And every time that shit goes up, you're making more of that alt. And when the time comes, I mean, who cares if you don't catch the very top? You think you would have been mad that you turned 126,000 Doge into only 472 and you didn't hold it until the peak of 650? It doesn't matter. The point is that you 4x your coin count. And it's for any, it's for any, we'll look at the last one. We'll look at ETH. I mean, shit. Let me tell you how crazy this trade worked out. And this is the first rotation, right? This, in my opinion, is the easiest one and is the one that everybody should be watching if you're gonna play that game. But look at how this played out. First, look at the coin counts, right? So if you would have bought Ethereum with your 15K at the bottom, you would have ended up with 11.8 Ethereum. Right? If you would have just kept your eyes on ETH BTC, which looks like this because 1 over is just inverted. No, don't do that. Do this. This is what ETH BTC looked like, right? Which means as long as ETH BTC is doing this, there's no reason to buy Ethereum over Bitcoin because you're losing value in it. So it says until you find bottom and you show some sort of reversal, right? You don't buy ETH. Now, did we buy ETH here because we thought it was reversing? Yep. Did we buy ETH here because we thought it was reversing? Yep. Right? But you pivot, So this was where you were supposed to really buy your Ethereum. Well, all right. Well, look at it this way, right? That 11.5 Ethereum that you would have bought at the bottom would have been 56 Ethereum if you held it until this topped out. or even if you didn't catch the top, 31 Ethereum. Same amount of money. You haven't put an extra dollar in the market at all. Right? Well, what happened to Ethereum at this time? Anybody that was here for this is epic. At the same time that Bitcoin was going up in value against ETH was dropping down to 1200, which is why you can afford 58 of them. Right? This is when everybody was saying ETH was dead. So not only do you not only have 11 Ethereum, but you turned it into 58 Ethereum at 12, which then ran to 44. Amazing trade. And it's just rotation. So a Bitcoin trade with this on top of it, and you had absolutely no complaints about this bull market just because we didn't have an alt season. Because there was so much money made right there. Talking 11 to 55, basically like a 5x to then buy the Bitcoin and then get a 4x. That's the boring work, though. It's not exciting. So because of that, sorry, damn, I didn't even mean to go on a whole TED talk over a simple ass question about what am I doing at the bottom. Because of that, there's a couple of things that I do at the bottom. Like I said, I buy good teams, right? The projects don't even exist. If they're brand new, resolve vaporware. There's nothing to invest in but the team, right? So I buy good teams at low valuations. And then I buy the picks and shovels for the upcoming market, right? Which are a couple of things. With Bitcoin, obviously, we just spoke why, right? And then the rails. Well, why would I buy? You're like, well, why would you buy BNB, Ethereum, Solana, and Tron if you just said holding Bitcoin will get you more of them in the future? The reason is because I think they might have a chance of outperforming Bitcoin early because as stable coins come in for the next bull market, then I expect those transaction values to go up on those chains. And there's a chance that they outperform. That's just a personal decision risk I'm taking, obviously. But that's where my head's at. And then the other picks and shovels are your gas fees. You don't want to sell Bitcoin every time a new project comes out that you want to invest in, right? And the money to buy your ETH or whatever is sitting in Bitcoin, it's cooking. So what you want to do is when ETH gets really low, you just want to get some gas. Whatever you consider a good amount of money that isn't going to break the bank, that doesn't come out of your investments, that's just meant to pay for gas, right? So you buy your SOL, you buy your ETH, you buy your SUI, and then you put those in your hot wallets. And the motivation for that is in 2 weeks, 3 weeks, when that new hot AI project comes out that everybody's talking about, your wallet's already loaded with gas money, with the coin that you need to buy the actual coin. You don't have to go into your Bitcoin bag and start selling shit because you want to join the party. Right? Everything is set up. Everything's set up. That's just how I do shit.
I got you. I was thinking like Grandpa. Obviously, he's the one that gets a lot of love at the bottom.
Yeah, he's got, I mean,
And
just
then maybe a few other.
dominance, right? It's all about dominance. But the scary thing about Dom is, what is Dom even doing? Like, Dom is still at above 60 still. Like, this should be down in the 30s and the 40s, and then during the bull market, right, Dom should be racing higher, which is why we sit in Bitcoin, because Dom is continuing. Like, are they really saying that it's not going to come down into the 50s or the 40s? At this point, bro, I would love to bring somebody in here that has that has explanation, I understand, but any forward-looking sort of idea, because for me, it just seems like the more shit that we piled on, the more dominance Bitcoin sort of held. All that institutional money isn't going anywhere, right? All that fund money isn't going anywhere. But the question is, what are the lows then? Because then we have to reestablish what an alt season looks like. Because in the past, alt season has been very easy to figure out. As the clown face shows you, recently, not so much. But we go to the daily. Right, so it's been pretty simple to see in the past. A massive drop, right? This is alt season. This is alt season. And the function of alt season is that it resets Bitcoin dominance. And then that climb for Bitcoin dominance, right, is what gives that power. But so what are we saying? I mean, I get it chart wise, right? Chart wise, this is an ascending triangle that broke out. And what it should do, honestly, is exactly what it's doing, not coming all the way back down. Right? Showing strength on the break. But I mean, he's 50, no? You know what I mean? Like there's gotta be something, because there has to be this ride back up. Unless we're saying that we're just gonna hover and then continue to ride. But remember what this means, right? There's only so much money in crypto. When you look at dominance and it says that dominance is at 60.1%, it means that $6.18 out of every $6.18 out of every $10 is in Bitcoin right now. Right. Alt seasons make it to where only $4, right, or $4.50 out of every $10 are in Bitcoin. And then as those dollars come back in, then dominance goes back up. And cool, all right, we're bullish. It's going to keep going, but how high? What, are we talking $8 out of every $10 is going to be in Bitcoin during the next bull run? And what does that mean for alts if that's the case, right? I think what it means is that, yes, it will be higher, but quantitative easing will bring in so much money that there'll be enough for everything. But we'll have to see how that plays out, right? Because that's just speculation.
Where does dominance typically sit in the bottom of the bear?
Like 45. I mean, we have diminishing returns. We've had 35s and then 45s. I would, at least 50 would be nice. But it's just interesting, right? Because as much as people talk about Bitcoin being played out and all this other shit, well, I don't know, because dominance tells me that the majority of the money in crypto is still sitting in Bitcoin over anything. We've never had it run without a full reset because of alts. It's like alts are almost like that pressure relief valve for Bitcoin dominance, and we didn't get it. So it'll be interesting to see how it plays out. It's never happened, so nobody can really, all we can do is speculate. I think what happens is that we have a big drop on Bitcoin dominance, but that isn't related to alts. Think of it like this. At our high, we were what, 4 trillion market cap, right? How much did they say they're expecting to come in through the Clarity Act with stables? 13 trillion. Stable coins are crypto. That means that it's going to show on Bitcoin dominance. That automatically drops Bitcoin down, but it doesn't happen immediately. Does it? You know what I mean? So there's catalysts there. And in the future, Bitcoin dominance isn't going to mean what it means now because of that. Because all those stables that are coming in, they're not coming in to buy crypto. So right now we get to look at dominance. We get to see, okay, how much is in stables, how much is in alts, how much is in Bitcoin through looking at dominance. And then we assume that when there's a bunch on the side that it's meant to come in, and when it's not, it's meant to go back. But what if those stables are here just to buy shit online? What if those stables are here to pay bills online, to buy, to buy a house, go on vacations? Because that's what the Clarity Act and the Genius bill introduced is stables for commerce. But they're still going to be counted in that dominance because it's still crypto. So we're basically going to have to just look at shit without ES, which we already do, right? But we're going to need a dominance excluding stables to get a true read of dominance and alts. And then just, we lose the edge of knowing what stables are meant to come in for us and not. Because in the past, if stables go up, okay, crypto's going to do well because it's only one reason to bring in stables. But now it could just be somebody buying a yacht.
27 is the stables supposed to start coming in?
I don't know what the date is, but I know that it's meant to be over time. Like, I don't think it's just going to be, but the ability for people to just look for the corporations, right? People keep talking about feds and all this, but just look for the corporations, not the banks, right? Not the hedge funds, but look for McDonald's, Starbucks, Sony, Nike. The stables are going to start popping up from them, and that's really what I think replaces the petrodollar, is that level of stake, because it's like customer rewards with a currency you control, and the only trade-off, that what makes it legal for them to do it, is if they hold U.S. bonds. And what do we have? A freaking bond crisis. What do we need? People to hold U.S. bonds. Lots of people to hold U.S. bonds. So you see how like the Clarity Act starts to make a little bit more sense, right? Okay, you want to have your own stable coin? Cool. When Facebook tried this shit, they laughed them out of Congress. They tried to come out with their own stable a while ago. They left them out of Congress. And then they came out with it was Project Libra and Project, what was the other one? Well, there was a second one that they came out, and Facebook was the first one to say, hey, what if we buy US bonds and do it? Because they felt the vibe when they went there, right? They're like, no, this is going to be a competition to the US dollar. We have huge reach. The only way they're going to back stables is if we use bonds to back. But it was too early, so it didn't work. But Zuckerberg actually deserves credit for that because he was the first one to bring that to Congress.
Adoption basically means that you can go to McDonald's and use a stable coin to buy something.
Yeah. It's, you know what it is? It's having a card that's like, and it's not even going to be coins because nobody has coins and nobody has wallets. These are going to be cards that are preloaded with wallets. That it's the same as like the card that you get stamped at Starbucks, right? Except now it's going to be loaded up with Starbucks. It's perfect. They don't even got to change the name, bro. It's going to be loaded up with Starbucks, and everything you do gives you Starbucks. And then they can program it, right? Oh, you got to use them by a certain time. And if you don't use them by a certain time, they get expelled. If there's a sale, then they can say, okay, hey, your Starbucks are 50% off if you use it to buy this item. Oh, we're not pushing enough lattes this month. A 25% deal with your Starbucks on. But in the background, to be able to do that, they've got to hold U.S. bonds. Now, multiply that by every major corporation in every major country versus what we were getting off of oil, which is a lot, right? Obviously, everybody needs oil, but way more customers for the debt like this. Brilliant when you think about it, bro. People think the government is stupid. They're really not. They play dumb. But when you really look at what they're doing and the problems that it solves and how intricate some of it is, not everybody in that shit is stupid. What happened?
Are you saying that this could turn around the bond market?
It has to. I mean, it's not only the bond market, but it needs to replace the petrodollar.
So we've got the bond market based on, everything we just listened to,
Hmm.
and I'm looking at my notes that I took, and it fracturing. So it sounds like what you're saying here is this could potentially be the savior of the whole bond market. Is
Yeah.
that what
Yeah, and
maybe we're thinking?
yeah, and
Ah,
I don't think it's I don't think it's a coincidence, right? Like I think that they saw the crisis coming. They One, I think they knew that the stability of the petrodollar was very weak, right?
right.
We knew that we couldn't keep our side of the bargain. That wasn't going to last forever. So we had to rotate. And if that's the case, if we're rotating, then we had to know that the bond crisis was coming, because any sort of uncertainty or panic on the, world reserve currency, people are automatically going to sell bonds. Nobody wants to hold a 30-year if they don't know what's going on. They're going to go to safety. So if you're going to have a bond crisis, then you're going to need to you have two problems now, right? You're going to need to replace the customers that you have for the petrodollar for holding US debt. And you're going to need to replace the customers that you have for bonds. And then stable coins come out and they give you this is why I'm telling you that what the stable coins did in 2022 needs to be studied, documented, and preserved forever, because they went from enemy number one to invaluable. They looked at everything that I'm just talking about and said, all right, I'll tell you what, because you guys are leaning CBDC right now and I can smell it. Tell you what, we'll buy the US bonds. Every dollar will back 1-to-1 with either fiat US or US bonds. And then Congress is like, oh, wait a minute. Like that low key solves both problems, right? We turn every government that wants to use, first of all, stables are backed on the dollar, right? So any government that wants to use stable coins has to hold US bonds, right? Whether they like it or not, because they need to be able to back their stable coins with something, right? If they want to have their own stable. And then at the same time, it gives us buyers for the bonds, right? So it gives us what we gave away in Iran, and it solves the problem caused by giving away what we gave away in Iran with one swift move. Now I could be reading into this shit. Maybe I'm giving them too much credit, but in my opinion, nobody ever benefits by mistake, and problems don't just get solved like, oh shit, look, what a happy coincidence that happened to. So there's people that are way above my pay grade that get paid the big bucks to think about this type of shit. I can think about it in my office. I think it's pretty safe to say that there was at least some forethought that went into it.
So what kind of timelines are we looking at for this?
Depends
That
on how
you're
fast everybody goes stable. Like, I don't think it's going to be a quick adjustment,
hmm,
but we started talking about it because we started talking about the cards, right? True adoption comes from you using something every day and not even realizing you're using it,
right.
right? So yeah, if you just have a card that you swipe and now you got your little Starbucks and you can use it to buy this and that, but you can only use it at Starbucks, right? It's not a stable you can use everywhere. It's a Starbucks stable. Then yeah, that's crazy for adoption. And it solves problems for everything. It makes those membership programs and those reward programs, it makes them more easier to manage, right? You don't have an expiration date at the bottom and you got to throw the card away. Like it just doesn't work past a certain date, right? By smart contract or whatever. And then for bigger things, you can scale that up as much as you can imagine. Visa just came up with all their chains, biggest payment platform in the world. If they want to use stables, they've got to hold. If they want to use their own stable, they would have had to hold U.S. bonds.
Yeah, so how would Visa do that then? Because they're not
They'd
going
have
to
to use existing stables. They'd probably just pick USDC or USDT. By the chains that they've picked so far, I suspect is USDT, because they gave us that list of chains that they're going to use to move, and they're all USDT chains.
Yeah, but they're not okay. So I don't understand how they would use it if they're not a company like a Starbucks where they issue a coupon, what is Visa going to do to encourage you to use?
Oh, they get paid off the transactions. They're gonna charge their transaction fees
Oh,
like they
yes.
always have.
Okay.
Oh no,
Okay.
you're paying Visa transactions. It just settles a lot quicker and it works a lot better.
Yeah.
And you don't realize that they're doing it with something that's a lot cheaper that you could be doing directly, but you're just used to using Visa, so you're gonna stay there.
So again, then you go, okay, that sounds so logical and would solve a multitude of problems. Where
hmm
do you get in on, like you say, the picks and shovels of the companies that are
Yep.
issuing these stable coins?
Which is
Or
why, yeah. Did you see the stablecoin deep dive that I did the other day, or did you miss it?
I probably missed it. I was out of town
Yeah,
for a
that's I
bit,
did a
so
whole. I'll post it. It should be posted. Honestly, I think it's posted in a daily. It's posted somewhere. I'll find it for you. But the research that
yeah.
I've done and what I've been looking at, like we call them the best, right? It's the BNB, Ethereum, Solana, and Tron are the ones that have the most movement on stables. And if you look at Tron's chart right now, I mean, yeah,
Tron, really? Boy,
yeah,
that was
I know.
it
Trust
gets
me,
so
I know,
dicey.
I know,
Gosh.
I know. Justin's son, it just gives you that nasty sort of
Yeah.
feeling. I get it, I get it. But if you want to look at where the money's going,
Yeah.
that's that's what's being used right now. And then they
Well, I remember
also
saying a year or so ago, because somebody was asking him on one of his streams, why Tron? And he said, because anybody with large amounts of money, that's the chain they're using.
yeah.
He said, that's just the way it is. And I thought, I don't have those large amounts of money, so it's not just matter of fact to me, but he said, anybody with millions is running it through Tron. I don't know if it's because of their fees were low or what it was, but that was just his
Tron is
take
really
on it.
fast. They're honestly where they shine is transactions underneath $1,000. Right.
Really?
Remittances, yeah, and that's why they do so well because that's basically everybody in the world for the most part.
Yeah.
People aren't sending around. But
I never
Visa
thought of
picked
it. I've
these
never seen Tron.
chains in their last so
Okay, I'm gonna
aside
take a
from the
screen.
Bitcoin, Ethereum, Solana, Tron, they've added Stellar, Base, Polygon, Avalanche, Canton. Canton is one that I'm paying attention to. Right. They're still relatively low market cap. And
Is
their
that
name
new?
keeps popping up. CC, Canton Network. It had a run towards the end of the last bull. It was doing well,
Okay.
but it's relatively new. Yeah. I'm gonna find that
So
I'm
base is Coinbase?
yeah, yeah. See, the thing
Oh,
is that
okay.
some of these aren't investable, right? Like you
Yeah.
can't buy base, you gotta just buy
Yeah.
Coinbase stock.
Yeah. Okay. That's
I
exactly what I was getting ready to say. So
yeah,
you just buy Coinbase stock. Okay.
yeah. I believe Arc and Tempo are private chains, so you can't buy those either.
Yeah, I was gonna
But
say I never heard
Avalanche,
of
Polygon,
Tempo.
Canton, they're near the. Interestingly enough, Stellar is over here and XRP is
Yeah,
all the way
yeah,
over
yeah.
here, but it's lonesome, which is pretty interesting.
Hmm. Okay, thank you.
Yep.
I'll go back and see if I can't pull up the little ditty you did on it, whatever it
hmm
was. Oh, can we even say that word anymore? Ditty?
I'll
Probably
find
not.
it. Yeah, no, yeah, for sure. He's doing his time. He's where he's supposed to be. Let me see if I can find it. Damn, I don't know where this is. Thought it would have been there. I really need to start titling these. Like when I do the deep dives, I really need to start titling the stream with the name of the deep dive. Oh, you know what? I think it might have been a bonus chapter. That's it. Nah, this isn't it. I'll find it. Need to go get some food though. You heard the man. Yeah, be careful. Be careful shorting XLM until Bitcoin starts to lose it. Because if Bitcoin happens to pop up even to like 76, 77, anything that's bullish is going to run. So be careful. Yeah, I mean, you got to get creative with it. It's more of a double bottom than a W. You know, those slow breaking W's turn into bear flags. But the reason I say you got to get creative is because you got to take one, and I have no problem doing this as long as you don't break bodies. You got to accept one wick and then reject 5 of them. Still gives you there's nothing wrong with it, right? Still valid. But I always rate patterns on perfect to imperfect, right? And even though you didn't break any bodies, that's a lot of wicks to get rid. That's the 30-minute too, right? So if you go to like the 5, then you're like, okay, now you're breaking bodies. Right. So to have it official there, you'd have to have it like this, and then you've got a false breakout. You get what I mean? So it's not perfect. It's sketchy at best, but it's not bullish, you know? It's definitely more bearish than bullish as of right now. That changes once you get out of this range, though. If you can break above that SR flip, then it's good. It looked really nice here, stopping volume candle. This is probably the last time that it looked really good, because now you're putting in a bearish channel on the top side. And we know these don't end great. So you're starting to see some bearishness in the structure. It's like a pattern filter. Everybody should have one, I think, right? And it builds over time. But it is definitely what I would call in the spirit of a bear flag, though. Definitely. If you ever have, if you're ever like 50-50 and you're like, damn, shit, I don't know, right? Go to your line chart. Your line chart is like your backup sort of arbiter of truth. Right? Does it look like a bear flag on the does it look like a bear flag on the line chart? Or are the wicks or the volatility mostly giving you the base? This still, in my opinion, right, in the spirit of a bear flag. Oh, it's gonna take plenty. It's gonna take tons of time, bro. But that's cool. Because nobody can take it from you once you have it. That's the great part. Knock on wood. And universe, if you're listening, this is not a manifestation. But I could lose it all tomorrow. Right. And while it would be incredibly difficult to grind back up to where I'm at, I could get right back because they can't take what I know. Right. I could screw up the bag. I could, they could cancel crypto forever. But unless they're going to get rid of stocks, unless they're going to get rid of Forex, unless they're going to get rid of commodities, if there's a fish market that has an opening and a closing price and I can go home and I can chart that shit on paper, they can't stop me from getting back to the bag because they can't take what I know because it was built over time. All right, universe, back into manifestation mode. Never be too careful. All right, let me go check on my food. This thing has to be here by now. I'll be right back. What's going on, chat? I only got my headphones back. I was trapped underneath these massive gaming headphones for like a week. She was driving me crazy. More than a week, probably like a month. Top of the range, bottom of the range. Stopping volume candle type 1, really low type 2, but still a stopping volume candle. Nothing to get excited about. But I'm gonna Just catching up on what I missed while I was gone. Damn, I didn't miss much of anything, honestly. A lot of nothing. Talk about playing with our emotions, huh? Yeah, it's coming up in when was it? The 18th, and then the 8th, 18th of June. But we got to deal with the current one right now. So we should see a bit of a retracement on liquidity here. I mean, for anything that's pushed, at least. Yeah, we got the 28th. 28th, 18th, 26th, 8th, 21st. 21st, the big one. I watched I don't know if y'all watched the show that Ben Cowan has with the dude from Altcoin Daily and the dude from Daily Access News. It was the funniest shit. But today was funny, right? Because today was like, is Bitcoin dead? Is it done? And these two go through the whole, yeah, well, it's getting older and it's just not exciting and AI and da da da. And I'm watching Ben's face the whole time and he's just frustrated, bro. He's just sitting there waiting for his turn. And they're like, so Ben, what do you think? He's like, well, I think it's a bear market. What the hell you guys are tripping about? Like, this is exactly what it's like every bear market. This is what it's like every pre-midterm election. Like, yeah, it feels like it's never gonna come back and it feels like it's all over and mom was right. Like, this is exactly what it's supposed to feel like. Funny, Issa. Ben's funny, bro. Ben's the best kind of neurodivergent. Like, little to no social skills, but like brilliant, so he doesn't matter, Funny. Yeah, which is exactly why I would love to have a conversation with him about COVID. Because I can't understand why he keeps saying something that he keeps saying that he's dead ass wrong on, which he doesn't do often, especially not repeat it. When it comes to macro shit, he gets something wrong, he doesn't tend to repeat it over and over. But this one, and it's just a small pet peeve. It's not really a huge deal, but when he does the macro analysis on Bitcoin, these are our bear markets, right? This is inarguable. This is the 4-year cycle. Right? Each one of these big green blocks is the top of the cycle. right? We've had 4 of them. For some reason, and I don't understand why, he insists on, and I only say it because I've watched it a million times, or maybe I heard it wrong. Let me listen to it again. He insists that this was its own bull market. And that this was its own bear market. And I'm like, no, bro. Nope. Not even, no. And the reason that he fell into the trap of saying it, and I know why, just, I consider him better than this. But he said it because of assets, right? He wanted to prove a point. And I get the point that he wanted to prove. But I don't know if he purposely, I don't know. But the point was that the last time that we came out of quantitative tightening, right, we ended up topping out. And then we only dropped about 50%, and then price kept going because quantitative tightening come out, da da da. And he kept saying this bull market is playing out the way that this bull market played out. And like, I'm just screaming at my TV like that is not a bull market. Right? I get it. We started popping up, right? Fed started popping up. We dropped right around that time. That is, yeah, that's equal. The difference is that we started raising rates. I mean, we started printing money halfway through this cycle, not even halfway, like maybe a third through this cycle, because we bottomed out here. This was just COVID. If COVID hadn't happened, then this would just be a big bull flag that ended up popping out. I don't know. Like I said, it's not a big deal. But if I met him, it would probably be like the second thing out of my mouth. Hey, what's going on, bro? Nah. Definitely big fan. Definitely follow a lot of yours. So, hey, let me talk to you about this. Talk to you about COVID real quick. Or security grabs me. I can't make sense of it. God, that's rude. You have your own screen. My bad, John. What you gonna do, Biddy? Mm-mm. What are y'all doing? I'm just over here grinding away at a couple things I gotta finish. That's good for that. I cannot find this video. I know I made it. So I guess we got to redo this. Nah, I haven't looked at my DMs at all, man. I've been running around. I'm just now sitting down, trying to get things in order. What's the TLDR? I'll take a look at it though. All right, I'll take a look at it. My bad. Ignore that. We didn't doubt it for a second, bro. Excuse me. I didn't catch that. I didn't see that. I've had my head buried for the last hour, DJ. What happened? I'm so close to being done with this stupid shit that I can smell it. Good morning, H. All right. Let's restart. I think I was talking it to muted mic. Let me restart the stream real quick so that we can save the class from earlier.